All right, thank you guys for clicking on this week's video. Today we're going to go over covered calls. So first things first, I'm going to show you guys how to do a covered call, and then afterwards I'm going to show you the benefits from doing this. Now I'm going to do this on Robinhood just because I'm assuming pretty much everybody has Robinhood at this point, and it's like one of the most popular forms of trading, especially for millennials. So let's get right into it. Right now in the example, I'm using American Airlines. Now when doing this, you always have to do at least 100 shares per contract. I'll explain later. So for example, we're only going to do one contract for this, so you have to buy 100 shares. So this will cost you about $1,137. And we'll get into the pros and cons and benefits and everything else later. So after you buy 100 shares, obviously you're going to place the order. I'm not going to place it right now. You're going to want to go to trade options. And the main purpose of this is you're going to want to hold these stocks for a long time. So these are stocks that you're going to usually hold for, a long time, while making some money during the meantime. So generally, the further you go out, the more money you're going to make. For example, like you see the expiration date is July 31st, which is like a few days from now. So that's why these contracts are so cheap, because obviously they're really not going to go past this. So to make more money, I generally like to do a month out. So we'll go August 28th. Now the benefit of this is you're selling these contracts. You're not buying these contracts like most people do. You're going to sell these calls, all right? So what you're going to do is you're going to want to pick one. Obviously, the higher you go, the less money you get, because less likely it's going to go to that strike price. The lower you go, the more money you'll get. But in a month, all it really has to do is, for this example, it just has to go over basically $12.67. That's only like what, like a 15% gain or something like that. So I generally like a nice little cushion. In a month, I don't think it'll go above, like $13.60. So you're going to go ahead and you're going to add this. And you see it's a short call. And you're going to want to do one contract. Now this is a minimum credit of $60. This actually goes to your account. And this is what you get paid. The main benefit of this is you don't want this contract to get exercised. If it doesn't get exercised, you get to keep all this money. If it does get exercised, you're going to have to pay whatever it goes above this. And that is why you have to have 100 shares, because this is based on 100 shares each. So to make sure you don't basically totally screw yourself over, you're going to have to do that. And I'll explain all the benefits later. All right, so first I'm going to explain this example that I provided you guys, and then afterwards I'm going to explain the benefits of it. So basically in the example, we've put $1,136 into this one stock, and we sold a call contract at $60, which was credited to our account. Now here's the reason we did this. Since the contract will only be exercised at the money, which was the break-even point, we will no matter what get $60 added to our account unless it's exercised. I'm sorry, I meant only if it's in the money, not at the money, because we still get profit from that. So let's say the stock drops 10%. Now we do lose our initial investment of 10% of the $1,136, which is like $136 or so, or actually even less than that, like $113. But we get debited $60 since the contract wasn't exercised. So it was really only a loss of about $53 or so. So this trading tactic kind of hedges your account. So if you know this stock long term is going to go up, but you know there's going to be an initial shakedown period and it might not go up for a little while, you could do this trading strategy. So every 30 days or so, you get those contracts and they help make you money. Now you're probably asking, oh, well then what's the downside? It kind of seems like you always kind of make money. And if you know this stock is eventually going to go up, what's the downside? Well, there's actually a pretty big downside, and it does kind of suck. That's why you don't want like a super volatile stock, maybe a slowly increasing gradual stock over time. Because let's say it gets in the money, since you have 100 shares, and the reason you do 100 shares is so it's even, right? And this is why. If it goes way above that, your money is actually capped at a certain profit just because whatever extra money you make with your 100 shares, since you sold a call agreeing that you were going to pay for basically that insurance on that stock, you're going to miss out on all of that profit. So for example, let's say the stock goes up to $20 per share. Since you bought it at $11.36, normally you would make $864 if you did not have that contract. And since the strike price is now 7 points in the money, and the way you get that is you just take the strike price minus the price it's currently at, 7 points in the money, 7 points times 100, it's 700, minus your 864 profit leaves you at a max profit of $164. However, keep in mind at the fact that you do get that initial 0.6 bonus, or in other words, that $60 credit. So realistically, your max profit is $224. So the best way to make your max profit doing this is if your contracts end up at the money or a little bit below at the money. Because if it shoots way up, you're not going to reap the benefit. However, that's very drastic. And in this example, that's basically like a 90% gain over 30 days. So just to recap, the pros of this, it's a pretty good way to hedge your account. And so you don't have to do a lot of work. It's kind of like lazy investing in my opinion, but not lazy bad, lazy good. It's pretty fun because you did all the research and you know the stock's going to go up. However, you don't know when it's going to go up. So every 30 days, even if the stock is going down, you're still getting money from the contract that you sold. And if it goes all the way up, then yes, you do miss out on the big gain. But if it doesn't go up all the way, you still make a decent amount of money depending on where you put your contract at. So I hope you guys liked the video. I love making these videos. I have plenty more content to come. I just want to give a special thank you. This is my 101st video, and I'm really grateful for all the 65 subscribers I have right now. I really appreciate you guys and all the comments that have been really encouraging these last few months. So I kind of want to make a different video than normal. So if you guys like this, where I actually go over like real strategies instead of like, you know, building a whole base foundation of like how to understand stocks, let me know in the comments below. I can definitely do more videos like this with like more real life strategies than understanding the stocks, even though I do believe understanding these strategies and why they work the way they do is more important than learning the strategies. But it's also fun to actually be able to like put these trading methods to work. So let me know in the comment section below. I really appreciate all the support. Remember to like, comment, and subscribe for more future content.